So it's worth at this juncture to go through some of the relevant economic theories of financial crashes that can be used to provide insight here. And one of the things that may not be obvious is that these so-called rational bubble models are perhaps one of the most useful tools in this area. Okay, so rational bubble models, it's very tempting to think of speculation and speculative bubbles as being characterized by irrational behavior, but actually rational bubble models, I think, give you some more insight, and they, for instance, give you some foundational support for extracting useful information from historically observed prices. So there's a paper by 2001 by Osborne, and this has got quite a nice interpretation to it, that investors may be drawn to markets at times of great uncertainty by the possibility of large rewards. So there is this underlying rational process here. This basic idea and intuition has been articulated into both classical models and also has some relevance from a contemporary perspective. A couple of my recent papers are listed there. And what I wanted to say again here is that the subject is inherently quantitative or mathematical, though there is still an economic story underpinning all this, and still a human story that needs to be told behind all the numbers and behind all the technical data that you might have available. It's important not to lose track of this. So alongside this importance of rational bubble models, one thing that is important to say is that, counter to the perceived wisdom, exuberance isn't necessarily irrational. So it's easy to take the title of the Nobel Prize winning economist Robert Shiller's book, Irrational Exuberance, at face value, where I think rational bubble models are actually more instructive, and it's more instructive, I think, to think of this thing as having rational underpinnings. So during bubbles, many participants are not necessarily irrational and collectively make a calculated gamble based on the risk-return trade-offs involved. This is the intuition between these two classic papers here by Blanchard and Watson and Johansson et al. In 2000. And indeed, I think this is a good lesson for life in perhaps holding off calling thousands and thousands of people stupid and irrational before you fully understand what's going on. So the basic idea is that as the background risk increases, the rate of return must also increase to compensate investors for bearing this additional risk. So there is an underlying rational process, but you may still expect to see irrational and very mad behaviour on the part of certain individuals, although this notwithstanding, there is a rational economic process underpinning much of the process. Okay, this risk-return interplay is key. Within these rational economic processes, it's often thought that bubbles actually serve a vital house-clearing function. This is the perspective and story told by this qualitative, purely written paper by Osborne in 2001, emphasised the interplay between risk and return. So this paper states this thing here: so to a reasonable approximation, people can access all the available information, yet still voluntarily participate in quite a risky and dangerous financial environment. So the suggestion is that bubbles and crashes perform a vital house-clearing function, enabling markets to sort truly profitable investments from merely illusory ones. Okay, so it's quite easy, I think, to imagine how this might happen with new technologies. So for instance, you could look at competition between different cryptocurrencies, and you could also sort of think in terms of new blockchain enterprises and how hard they're working to make sure that they're successful and that they don't fail. Also, I think there's a sort of natural analogy to draw here between professional sport, and sometimes a very thin dividing line between success and failure. So if there is this vital house clearing function going on, just beware that this process might be fair, but it will be brutal. Okay, strong analogy there with professional sport. So another thing that is often emphasized during speculative bubbles is market fundamentals. So this process may take a long time. Indeed, there's a quote by Keynes that the market can stay irrational longer than you can stay solvent, but any functioning market has to ultimately reflect economic fundamentals and economic reality, otherwise what's the point? So two papers here that stress the importance of economic fundamentals are Zera 1999, and Baldwin and Levine 2001. So 1999 is a classic paper I like to cite time and time again, and is the more sophisticated approach. So here this stresses the role of so-called information overshooting, and there's an important truth here: information and how that information is processed may ultimately be more important than fundamental economic and technical truths. So I think what this is pointing to is that sometimes self-fulfilling perceptions are themselves important. Also worthwhile bearing in mind here are many historical examples of a separation between technical specifications and profitability. So examples here include Concorde, VHS versus Betamax in the video cassette market, and Porsche versus TVR. Doubtless you can think of your own examples yourself. Okay, so informational overshooting there in this paper by Zera 1999. So the basic idea is that market fundamentals change over an unknown period of time. The market expands to new capacity which is unknown until this capacity is finally reached. So the crash finally occurs when information about this limiting capacity is finally processed, and this becomes known and obvious to everybody involved. Okay, so there's two main ingredients that underpins this story. Firstly, rapid technological progress. Secondly, an influx of new investors. And I think one of the things to sort of anticipate here is that if you've got change driven by rapid technological progress, as part of that, you're likely to see non-traditional investors enter the market. Okay, so the basic idea here is that behind lots of individual acts of folly and stupidity, there's a fundamentally rational economic process at play. Okay, and this is intended to have quite a broad range of application. Certainly you can see how this could apply to contemporary examples. So rapid technological progress fits in nicely with developments with blockchain, influx of new investors that could conceivably be non-traditional investors in blockchain technology or cryptocurrencies. Okay, so to bring this home then, so there's certain elements of information overshooting in the Bitcoin market. So certain aspects here might include limiting capacity. So legal aspects are often one of the things overlooked by fintech, but it's very easy to see that legislation by national governments could easily put a block on initial growth. Similarly, if you have steps taken by large US financial institutions, this may have a similar limiting effect. It's thought, for instance, that recent innovations made by some US institutions might render Ripple obsolete. Also, another important point here regarding limiting capacity is a slow initial rate of adoption. Blockchain is a new technology, but there remains a lot of fundamental uncertainty irrespective of this possibility of foundational societal change. And it's natural to think, with respect to Bitcoin and blockchain, of an influx of new non-traditional investors driven by this new technological innovation. So speculators, computer geeks, cryptocurrency millionaires, etc. Okay, so as the technology changes, the idea is that this might have a democratizing effect on the participants in the market. Okay, so another aspect emphasized by Baldwin and Levine is this notion of technology shocks. So the idea here is to emphasize the role that physical factors play in affecting an economic process, known very formally to economists as production, rather than the flow of information. So the idea is that when an old mode of technology cannot be improved further, it is replaced by a new one. The dismissal of old technology and its replacement by new technology can trigger recessions which end prior to the development of the new technology being completed. Okay, so this might tally with some aspects of Bitcoin and blockchain with respect to low levels of initial adoption. Okay, so the prediction of this model by Baldwin and Levine is of large and sudden crashes which follow periods of regular growth. And the idea in this case is that crashes are the result of fundamental factors, not market inefficiencies nor investor irrationality. Okay, so I think there's certain aspects of this which don't necessarily tally particularly well with Bitcoin and cryptocurrencies. So periods of regular growth, I don't think that's something that you often see with many cryptocurrency prices. Prices are much more volatile than that, and aspects of investor irrationality often as well. So if you emphasize the role of new technology and the technology itself, as Baldwin and Levine seem to do, then this has some fundamental weaknesses in terms of how this applies to Bitcoin and blockchain. Precisely this approach downplays the role that self-fulfilling expectations can have on the part of market participants, and you're always going to have, I think, a wide deal of speculation whenever new technologies are involved. There's a paper by Lee published in 1998 which emphasizes something called information aggregation. This works a little bit like an earthquake. So building on this analogy, the idea is that information builds up in the market but remains hidden. This information may be released by a small trigger, and then this information release causes a crash rather than the irrationality of investors. So this has some relevance to the dramatic crashes that we've seen historically in cryptocurrency prices, and I think this perhaps tallies more clearly with some aspects of fundamental uncertainty which characterize the subjects of Bitcoin and blockchain. Okay, and this idea of there being sudden dramatic crashes, I think, arguably more realistic. So in defense of rational bubble models, so despite instances of mass panic and hysteria, this paper by Zero in 1999 sees bubbles and crashes as a rational economic process that follows, says they're new financial liberalizations. So when you see the term financial liberalizations, just think new economic freedoms. These new economic freedoms are usually linked in a timeless fashion to either new technology or an influx of new investors. So my own view would be, I think it's better to assume that thousands of people are not just stupid and a collective risk return into play is actually going on here. So I think this is a good life lesson. Better to think very, very carefully before you call thousands of people stupid or irrational. Pragmatically also, beyond that, rational bubble models mean that useful information can be distilled from market prices, even if these prices themselves cannot be taken at face value. So I think that if you want to characterize speculative bubbles as a purely irrational process, this might have certain far-reaching implications in terms of how much value market prices have. Okay, fine not to take them at face value, but it's likely that they still contain some useful information. Okay, so in terms of a discussion on irrationality, trying to encourage here as broad a perspective as possible. Remember, the subjects of Bitcoin and blockchain are bigger than one individual discipline. Okay, so you want this sort of breadth of perspective. Now, I think there's certain cases here where rational bubble models give you more insights, but there may be instances where irrational behavior outperforms rational behavior. So as an early example, I remember from my university studies, some people can solve a Rubik's Cube faster than a maths professor rigorously applying the mathematics of group theory. I've always worked as an academic, so I try whenever I teach finance topics to remember my own limitations. It'd be perfectly reasonable, I think, to ask an academic, if you are so smart, why aren't you so rich? Beyond that, I think it's also very possible that a certain degree of technological irrationality and overexuberance is beneficial to society. So a classic example that's often cited here is technological innovation that accrued on the back of the space race in the 1960s. So perhaps you can't justify rationally the cost and expense of going to the moon, okay, but it's still important as a species that we did that, and there's all sorts of technological benefits you've got on the back of the moon landings.